Welcome back to the Gold News channel. Today, I'm talking with Alexander Scanlon. Now, he's the managing director and CEO of a company by the name of Barton Gold, who are exploring down in South Australia. But that's not why I brought Alex on today. I've brought him on because we want to talk bigger picture about gold. I'm getting a lot of questions from you, the community, about why you should be looking at gold, or in fact, silver, I guess precious metals as a whole, and what's going on in the bigger picture out there with governments printing money. And Alex and I were talking a few weeks ago, and he had some views on what's going on globally and, of course, here in Australia. So I've asked him to come and join us today, possibly just to really talk about what he feels is the macro outlook, perhaps give us a little bit of his views on where to now for gold. So, Alex, great to see you. Thanks so much for your time, because I know right now, especially leading into Christmas, is a very busy time for Barton Gold. So we'll come to Barton Gold at the end of this just to give people a bit of a quick update. But let's just talk about your views on what's going on in the world economy and, I guess, a macro outlook, your views.
Yeah, it's probably worth, I guess, just noting is, I'm not necessarily a gold bug in the historical sense. And my background, I'm not a geologist, a metallurgist, or a mining engineer. I'm actually an economist. So I tend to sort of look at things from sort of that macro big picture perspective and try to just think about what are some of the big, more obvious markers for what we see going on around us, and where that might suggest that we're heading. And I think the interesting thing about gold is that, for thousands of years, we have had a social contract around the value of gold, right? And that's to some degree being tested or sort of prodded or potentially even distorted by the advent of things like crypto and various different alternatives that people can invest in, including different forms of investing in gold. But fundamentally, I think one thing really does hold true, and that's that as we look across time and generations and transfers of wealth, it's not the transfer of paper that preserves wealth across generations. It is the transfer of physical assets, real assets. And by and large, throughout history, what we have seen is, the transfer of property, real estate, and the transfer essentially of metals-based wealth. And of course, gold and other precious metals being the densest form of that wealth. These are the most efficient ways to preserve capital. They are therefore, we arrive at sort of the natural, starting point for a lot of people, which is these are a hedge against inflation, right? They're limited in supply. In the case of land, it's extremely limited. They ain't making any more land. And so, when we think about gold, I think it's helpful to start with that really long-term time horizon and then look at what happens, along that time horizon. But the interesting thing, the interesting situation in which we find ourselves now is that there are some real dislocations in the patterns that we see around gold, or the way that gold behaves. And when we think about gold as an inflation hedge today, we're looking at a situation that I think is actually fundamentally changing quite rapidly. So gold as an inflation hedge is equally a hedge to poor decision-making and short-termism by people who control the levers of power when it comes to printing money, right? So we can look at that, and if we look at that as a simple premise, what we see is that we're kind of having probably the biggest macro setup in generations when it comes to gold price. When we look at gold as a traditional inflation hedge, we think of that long-term relationship between printing and prices and money and inflation. But the key thing here is on the supply side of currency, we've seen a massive structural shift in these key drivers. And that really comes down to the fact that during the past 10 years or so, the traditional relationships around sort of fiscal conservatism and monetary policy, they've more or less dissolved. We saw this with the start of, we saw this sort of really start with the GFC. So during the GFC, obviously, I think we're all familiar with that story. A lot of very risky debt out there. Markets essentially collapse under their inability to refinance that debt. And the government steps in the US with a $1 trillion bailout package, approximately $1 trillion, known as TARP. That was one of the first times that so-called Western economies got a taste of sort of free money policies. And what was interesting is after markets were stabilized, coming into early 2009, equities markets stopped dropping, started recovering, and we basically saw a sort of close to a 10 or 12-year bull market now from March 2009. But after markets have stabilized, what didn't happen was that the money press didn't turn off.
Yeah.
And central banks around the world sort of continued printing money, led by the United States Federal Reserve. And if you look at the long-term sort of M1 money supply chart of the US, you have this broadly just flat line from 1960 going through 2005 or 2008. And there are some really simple tools you can look at out there. The St. Louis Federal Reserve publishes these charts. It's very, very helpful. You can just look up M1 money supply. And from the GFC to about 2020, we see a distinct sort of uptick, an inflection point where they started printing much more aggressively. And the availability of US dollars in terms of M1 money supply more than doubled between 2010 and 2020. But when we think about COVID policy response, where do we find ourselves now? Well, we find ourselves in a situation where, despite having had a booming global economy for the past 10 years, rates have been held to near zero. Money supply globally has more than doubled. And the analogy I use for this is sort of like, we have money supply in reserve as a tool, as an arrow that we can fire when we really need to strengthen the economy. Well, between 2012 and 2020, when things were boom times, we had the Federal Reserve just launching all of their arrows out into an empty field with no enemy in sight. And then something like COVID comes along, something predictably unpredictable or just unpredictable. And now we have a real enemy banging at the gates of the global economy, but we fired all of our arrows. We are at near zero rates. And there's nothing that we can do but turn up the volume on printing if we want to make sure that people have liquidity and currency. So from, the big question is, what does that look like? And I think one of the simple questions is how much money has been printed in the past 20 months, right?
Yeah.
And you sort of go, was it another $1 trillion? Was it $5 trillion? Was it 10? In fact, the US M1 money supply has more than quadrupled since the beginning of 2020. So at the beginning of 2020, it was about $4 trillion US dollars, and currently it's about 20 trillion US dollars. So it's gone up 400%. So this is currency held outside of the US Treasury, outside of the Federal Reserve, outside of deposit vaults. So in the broader context, our money supply measured in US dollars is now 12 times the post-GFC M1 money supply. The policy response over the last 20 months to COVID has been 15 times larger or more than the policy response to the GFC. So we're in a situation where the traditional relationships, when we think about money supply and inflation and gold, they're just broken. We've seen a complete structural shift, and we don't know which way that's going to go, but it doesn't seem likely to be good. And the government is essentially heading into the same debt trap as everyone else. So they are, the US government is the most indebted in the world. They can certainly least afford to be running $3 and $4 trillion a year deficits and have interest rates go up. But they also cannot pull this money back out of the economy without crashing the very economy that they're promoting with all of this printing. So it's a real paradox. And this is why, when you hear this discussion about, inflation is transitory, it's nonsense. And the people who are saying it know it's nonsense, because you simply can't unprint that capital without destroying the economy. And you can't quadruple or quintuple the money supply without that physical supply of cash outside of the Federal Reserve finding its way into circulation directly or indirectly through financing. So I think that we've entered a terrible new world of sort of wishful thinking. And we are now starting to see, 12 months or 16 months after these really big packages of printing were undertaken, that in fact inflation is running at a published rate in excess of 5%. If the published rate is 5% plus, we know that the real rate is in excess of that, because the governments are very selective about how they measure inflation, and they're selective about what prices they include in that basket. And I was struck by something that one of your other, a very well-known guest of yours said at the Gold Conference last year, Rick Rule. He did highlight that, when we think about government measures of inflation, government measures, CPI, do not include taxes and transaction costs, right? And
taxes and transaction costs aren't included.
Look around the world right now, and what is the discussion point? Raise taxes to finance our COVID relief packages. Raise packages to finance our economic relief packages. So we in reality have a much broader based problem with inflation shaping up. I think that unless transitory means severe and long lasting, then I think everybody's pretty clear that transitory was a kind of a farcical game trying to calm people down for a while. And I think that the supply side issues, which are driving inflation, are going to end up being sort of the double whammy here, right? So we've now printed a ton of currency, so this is splashing around. But now we have a ton of currency splashing around at the same time that we have other supply side issues, which are supply side restrictions on raw materials and inputs. So we have supply chain disruptions. That's a problem in the first place. And now the Federal Reserve in the US is shifting its discussion from saying, oh, well, inflation is not transitory because we had these supply chain disruptions, but don't worry, those will be resolved within another year's time. Okay, fine. Let's assume that is the case. What will they be shipping in a year's time if the world supply chain comes back together? The world supply chain will be shipping commodities which are trading at 30 to 200% greater the price than they were 18 months ago. So we have higher input prices, which can only lead to higher output prices and consumer prices.
Yeah, because that's the top of the chain, isn't it? When you look at commodities, and then it just passes on down to
correct. So we've got these higher input prices, and we've got consumers with more money in their pockets, and we have extremely high labor mobility. In the US, something like 4.4 million people quit their job last month in search of a different job. Now, that means 3% of the United States' entire employed population quit their job. That is real confidence, right? They are going somewhere else, and they are getting much higher pay. Now, higher consumer prices and higher pay are very sticky things, because you can't suddenly take that away from someone without essentially labor rebellion, right? And business rebellion. So more money meets higher output prices meets, it creates a higher clearing market for prices, and that's going to be sticky. And then, let's play this out 24 months forward. We say, okay, well, the supply chain gets fixed. Once that all happens, will input prices come down? No, they won't, because the actual fundamental restriction is a shortage of the raw materials. Demand for these raw materials in the EV-driven, greenification environment is increasing rapidly and far above the capacity for mines to expand. And one thing that I think the world is yet to catch up with is for the world to continue its rapid green evolution and energy evolution, the amount of raw materials and specialized raw materials like copper and rare earths and nickel and graphite and all these things that go into energy storage, that amount of material produced has got to go up dramatically. So there's got to be a one-time massive production of this stuff to meet the requirements of the next 10 years. And then we hope that we can recycle that. Whether or not we can do that, we'll see. But the key point is, it takes a very long time to fill the supply side of this equation when it comes to mining. It can take 20 years to discover and delineate a large project and get it permitted and get it developed and get it in full operations. So it is purely wishful thinking that we have massive supply side constraints, whether on delivery or the actual supply, that will suddenly be better just because all of a sudden the trucks and the ships are running again. We are looking at a multi-year problem to actually bring commodities prices down. Ergo, we cannot have lower prices. Ergo, inflation is going to continue. It's very, very simple.
You mentioned a bit earlier that politicians, they're not long-term thinkers.
Yeah.
So on that basis, all they're doing is saying, well, during my time in office, I'll print some more money. I'll give away lots to people just to settle them down and put a smile on their face and win a vote.
Yeah.
So it's not, nothing's going to change. So I guess what we're looking at is higher prices because of more liquidity, because of more what I call funny money going into the system.
Yeah.
Why should we care? Everyone's going to have that sort of wealth effect of, well, inflation might be here, but I've got more money, like the government keeps handing me out money for left, right, and center. So I'm feeling wealthy.
Yeah.
And if I'm not feeling wealthy, Alex, doesn't matter because I can go on to the government handouts, which are getting bigger and bigger as well. So
Yeah.
does that mean that money per se becomes irrelevant and the governments turn around and say, well, we'll just come to one world digital currency and reset everything?
I think there's a lot of interesting points to touch upon in there, right? But I think that conclusion of like, well, money is irrelevant and now we just come to a digital currency can only be the case if there is a completely comprehensive social contract that is the case, right?
Okay.
You know, if we look at, you know, the issue of politically driven monetary policy intervention, I mean, it's always been the case that, again, you know, politicians of any party affiliation will look to large scale deployment of capital to boost an economy. And sometimes that can be healthier and sometimes it's less healthy. You know, we see large scale investment in infrastructure that can be very, very healthy for the long-term development of a country, and also the quality of life for its people, right the way down to the ability of people to get quicker to different locations and therefore even have a better education as a child. And that has all these positive knock-on effects. But going back to the point you sort of raised at the beginning, you know, one of the points I like to make when we sort of get in these debates is that politics is a short-term game, right? And it means that it is dominated by short-term players. And politicians, broadly speaking, have an either a 2 or a 4-year re-election incentive. And so they sort of play on a 2 to 4 year game, but they will take decisions and do things that might have 20 or 40-year consequences, right?
Wow, I hadn't told that. Yeah.
The simple way to sort of summarize that is that, you know, basically short-term players do not make long-term plans, right? They will do things today while saying that inflation's okay, that actually exacerbates that inflation.
Right.
And part of this is sort of the, you know, the immediate convenience factor that suits their the political narrative. And this is true across all political parties and all spectrums. It's simply the case that politicians, and particularly in the past 10 or 12 years, have learned that they can spend, you know, $2 billion or $2 trillion to pick up a marginal vote and get reelected, which is their primary concern. But what that does is it basically adds to the future inflation pipeline. And a lot of this has to do with sort of showing voters of all different ilks a piece of cake today. And as you say, oh, it's okay, the government's going to give me something and it's really great and it's all good. They're showing you a piece of cake today, but the effect is that you or your children or your grandchildren will owe 10,000 cakes for you to have that piece of cake today. And effectively, whether we're talking about the supply of dollars or the supply of cake, if there's more of it, it's less valuable and people care a lot less about it. So there's no point at which we can all say, well, there's just more money So we're better off, because whether it's the case from social dynamics, or whether it's the case from savings dynamics, rapidly increasing capital in terms of the number of printed dollars can't be good. If we're talking about printed dollars, what it means is that you should never save money, because the government's destroying it faster than you can save it.
Yeah.
If the inflation rate is running at 2% per annum, what that means is that inflation will essentially have the real value of your money over a 35-year period. But if the inflation rate is running at 5%, that sort of half-life goes down to 15 years. If the true rate of inflation is closer to 10%, that half-life is 7 years.
Is that right? So close to 10%, it's 7 years.
Your half-life on the value of on the real purchasing power of your capital is 7 years. If you want to flip that around, at 2% inflation, the value of $1 today will have 50% the purchasing power in sort of 35 years.
35 years, yeah.
At 10%, it'll have 4% the purchasing power, which means if you're saving money for retirement today, you are retiring penniless, essentially, no matter how well you save. On the social issues, what happens, with all this money coming into the market? Well, if I am if I'm a wholesale financial institution, or if I'm an investment bank, if I'm a retail commercial bank, when I take $1 from the Federal Reserve take $1 from the loan window, I can lend that 8 or 9 times against things like real estate.
Yeah.
Which will exacerbate the already booming market that we see in real estate. And what that means is that those who do not have real estate, or who are not on that ladder, may never be able to get on that ladder, because the nominal value of a property, when trillions of dollars is getting pushed into that market, it will put it well outside of the reach of younger income earners, whose income clearly is not going to grow as quickly as money is being printed and then multiplied against tier 1 reserve and capital requirements when banks are lending against real estate. So we can end up with some really serious social problems in terms of division of wealth, accessible housing. And if we think about what proportion, in a country like Australia, what proportion of your income is dedicated to housing, right? Cost of shelter, you see people spending between 30 and 50%. And now if the cost of that housing is going up 10% per annum or more in certain cities, and that's 40 or 50% of your expenditures, it simply can't be the case that inflation is the 2% the government's telling you. So this is what's all very troublesome about this. Eventually this story sort of has to fall apart, and then you end up in that.
But let me interrupt you there.
Yeah.
Does it have to fall apart?
Well, it's never in history has this type of print your way out of debt theory worked, right? We have 2 really salient examples in the last century. One is Weimar Republic, Germany, right? And the other is Zimbabwe, right? We can't fund our initiatives, print money. People are losing confidence in the banks, print money. We can't repay debt. It's okay, just print more money. And you basically flood the zone with capital. But at some point, that capital becomes meaningless paper, and people are paying for a sandwich with stacks of bills, right? So it's now I'm not going to,
do you think we're going to get to that particular chaotic moment in sort of, I guess, in Australia, the US, globally these days? Because we are living in slightly different times, but maybe it's not.
Well, look, I don't know, right? And that's the thing, is these things become very unpredictable, because this is the first time that, again, your really dominant economies have gone this path. It's the first time we've seen this happen, and we're about 12 to 13 years into this really scary free money policy experiment.
And sorry to interrupt you again, Alex, but are we doing the same in Australia as much as they are in the US? I mean, the US is a much bigger economy. we don't seem to have gone quite down that path of printing to excess down here at the moment.
Yeah, I think it's more constrained, right? I think it's more selective, more targeted. Where capital is being spent and the amount of borrowing. But one thing that we keep learning every 10 years when there's a crisis of some variety is that markets are all connected. Contagion is global. And even if, for example, Australia were to entirely decouple from the financial markets of, Europe and the United States, as long as we're willing to exchange US dollars for Australian dollars or accept US dollars for Australian properties, then markets in fact remain connected, right? As long as you have anything that's fungible for another ties the markets together. So, the question you pose is a very good question. What will this lead to? I don't know, other than it will lead to continued significant inflation in those things, which are sort of inflation sponges, which are property and in gold is another one. And gold is a more volatile thing, but it's long term. It's always had that successful affiliation of either absorbing nominal dollar value or preserving its purchasing power better than other alternative investments. So,
but it hasn't quite done that at this stage right now. Or do you think,
correct.
It's almost like a coiled spring. It's pulling in all that sort of energy, if you like, of all the extra dollars. And there will come a time when people least expect it, that gold will suddenly say, you know what, here's the answer, bang. I mean,
yeah, I think we're looking at that type of a situation. And we do have one, we have one very strong exemplar in very recent history of that happening, which was 2009 to 2012, right? So we're kind of right now in the 2008 period. Markets are frothy, maybe getting unstable. We're seeing a lot of capital, a lot of very exuberant and perhaps overly exuberant capital going into things. We have a lot of distractions and a lot of things in the market that keep people very excited, whether it's some of the new sort of tech-driven things, whether it's crypto. But we see, Rivian, for example, IPO'd as the world's third most valuable automaker with $0 in revenue. So we're starting to see this extremely frothy, bubbly market type activity that we saw back in the years 1999 and 2000 in the US. We're on the tech market. We're also seeing a very frothy market in real estate where valuations are just charging the world over. And it's being driven by these very aggressive lending practices. And that's being exacerbated by the amount of money that's being pushed into the back of these banks. So, it is I think, we're still setting up crises of confidence, and markets collapse a lot faster than people gain confidence and markets rise. So, when we saw even in the GFC, even when markets crashed, the gold price traded sideways in sort of $100 volatility for about a year's time, from the end of 2008, September 2008 to September 2009. It was almost a 12-year period.
Yeah, 12 months.
Yeah, exactly. And so if you look at where the gold price was coming into the GFC, we have seen broadly the gold price trading in about $100 price range, aside from, late 2020 when we saw the gold price go up to about 2,000, right? People got very excited about the gold market then, but it had to release some of that steam. And particularly, it was going to release some of that steam when economies were unstable and other asset prices were resetting, because gold actually did fulfill its purpose. And I think people go, well, why didn't the gold price shoot through the roof with COVID when markets went down? Well, the purpose of gold is to ensure that somebody has liquidity, is to provide fungible currency when they can't trade other assets. So you saw institutions selling off gold to pay off their margin positions on other assets that had decreased in value.
Oh, is that what happened? Okay.
So gold performed exactly what it is supposed to do. Now, where is it today? I think it's sitting in that sort of pre-market recognition or pre-realization volatility range. And to be trading inside, put this in perspective, to be trading inside of a $100 valuation range, broadly defined, on today's price around $1,800 means it's only half as volatile as it was in 2009. During 2009, it was trading in a $100 range around a price of about $900.
That's right.
And then from September 2009 to October 2009 to October 2012, it went from $900 to $1,900.
Yeah.
So we look at I think we see this situation where that was predicated largely upon institutions then realizing, hey, all of this risk is built up in the system, all of this money is being printed. Right now, institutions are still very much enamored with fixed income rate securities. They're pursuing a very hot market on equities. It will take very little for markets and institutional investors to get uncertain about listed equities, to get uncertain about highly speculative tech ventures that are essentially all story stocks. And it would take a very small proportion of that capital deciding it's going to reallocate to a defensive position for the gold market essentially to be overrun with physical demand. Now, does that physical demand eventuate for paper gold or physical gold? In theory, paper gold is supposed to be backed by physical gold, but we know that's not really the case in most circumstances. But I do think that we're probably looking, again, because we've had this structural break in the way that we print money, we're probably looking at the greatest macro setup for gold in any of our living lifetimes. And where do we go from here is the very interesting and possibly very terrible, very interesting question, possibly a very terrible answer. But I do think that gold is going to be recognized and sort of resume or sort of maintain its long-term relationship with monetary policy over the next 5 and 10 years.
I think it's an interesting look at that, because there's a lot of talk at the moment about CBDCs, central bank digital currency, whereby they can essentially and potentially make gold irrelevant. It becomes irrelevant because we, the central banks, have decreed that this would kind of do a reset. And you don't need to worry about that funny stuff over there because this is the way of the future. What do you say about that?
Yeah, I think that would require people to suddenly have extreme faith in governments and central banks. And I would say that
don't have extreme faith in governments.
I would say that the world as we have known it for the past 5 years is heading the other direction. We are seeing a crumbling of faith in institutions. We are seeing the fairly rapid dissolution of some of the sort of tenets of global treaties and trade that we've relied upon in our post-World War II economy for stability and for, let's say, mutual gain. There's a lot of inequity within the broader market, but we are seeing the dismantling of the very things that we rely upon for stability. And we are seeing governments dismantling institutions or undermining institutions or the faith in institutions that would be required for people to suddenly say, don't worry, I hand over my welfare, my financial welfare to the government to manage for me. In the United States, how well has the government managed the Social Security pool? Not at all, right? There's a real risk that those who are paying into Social Security today don't have Social Security available to them in 30 or 20 or 10 years. So we sort of enter a very philosophical realm when we're talking about this kind of stuff. But one of the things that we're really seeing driving cryptocurrency, for example, there's certainly a FOMO effect, right? There's a fear of missing out.
Absolutely.
But there are also people looking at this on a couple of key factors, which include, among others, one, in theory, mechanisms that are meant to limit the supply of a given currency. Ergo, it's, we hear the claim that it's like gold because it can't be printed and essentially counterfeited into perpetuity by the government. And that is all based in actually an increasing distrust of the government to look after one's welfare. I I think that the prevailing sentiment right now is people saying, I want to be sure that my future financial welfare is independent of the government.
Yeah.
If we say we've got I mean, what do we really achieve if we say, okay, now we've got a central bank digital currency for the United States? Oh, we have, what do we have? US crypto dollars. Well, how is that any different than having the ability to electronically transfer dollars in my US dollar account?
Yeah.
It's fundamentally no different, except your dollars are actually sitting on a government register. And that presents some interesting questions, right? If you now bank at the digital bank of the United States, or the digital bank of France, or the digital bank of China, what happens if the government decides to just turn off your account to punish you for something?
Absolutely. Yep. It's what your records were saying, that this could happen easily.
There are sort of too many ways that there's sort of too many ways this can go terribly wrong. And I think the governments are really grappling with, how do we deal with digital currencies? Oh, we'll offer an alternative that's in theory the same thing, but backed by the full faith and credit of, insert government name here. The problem is that will come with a whole mess of privacy concerns and security concerns that people who might be buying gold or crypto already very strongly have those concerns. So
yeah, Alex, sorry to interrupt you, but right now, again, the currencies are based on trust. We trust the government, therefore we trust getting this, this dollar bill in our wallet or sitting in the bank. It's a trust thing behind it. Why do you think more people don't trust the wealth properties of physical gold as a store of wealth? Because it's very, very small at the moment. Many people would turn around and say, well, why should I own gold? It doesn't give me anything, because they're used to the funny money. They're used to the currency. They trust the government and they don't understand gold. Do you think there might be a tipping point where the blinkers open?
Yeah, look, I think there's a few crisscrossing factors there. I mean, I don't think people necessarily say, I prefer this capital because I trust the government. I think they prefer this form of capital presently because they can take that dollar, that form of capital, and insert it into a hypercharged equities market and try to play the game that they can bet better than anyone else when to get out, right? We are seeing the greater fool theorem played out on a global scale, with tens of trillions of dollars of new capital being pressed into capital markets. The greater fool theorem requires that somebody loses at the end. And it's usually the people who can least afford to lose. We are very much in sort of uncharted territory in many respects. But when we think about, okay, well, why does this mean people don't want gold? So I think there's a distraction factor there. And when people say gold doesn't give me anything, I mean, one thing, particularly when we think about physical gold, one very desirable property that it has is that it's tangible, right? If I have a gold-linked ETF, if that crashes, there's a really good chance that it's not going to be holding any gold behind it. And even though I think I've had exposure to this thing, which should be defensive and a store of value or purchasing power, even if the nominal value goes down over the long run, it should be a store of purchasing power. I can lose that value entirely, right? I can lose my dollars invested in the stock market, but people just aren't sort of thinking that way right now because it's the sort of everyone's getting rich thing. We've seen this before. We saw this in 1999, both in the tech bubble. We saw it with long-term capital management, blew up trillions of dollars in derivatives, and without the government essentially directly bailing them out along with banks, we would have had a much more serious global economic collapse linked to that fund. When preferences shift, I think they will, you will see demand for physical assets picking up again. Right now, that we're seeing increasing demand for real assets in the form of housing because money is cheap. But again, thinking about, the crypto versus the physical gold question. Well, if I'm holding crypto, it's an exciting story. And look, I should say, I am no expert on cryptocurrencies, right? So I'm not an expert on cryptocurrencies.
Neither am I.
I'm certainly not an expert on the technology behind it. But if you look at some of the bigger picture, sort of political and regulatory and behavioral aspects that are there are also some issues that you've got to deal with that relate to the lack of it being a physical asset, right? So like gold, the value of cryptocurrency is essentially a social contract, but it's partly based upon the premise that it's got value independent of the government, right? Well, or that it has some intrinsic value because there's a limited supply. I think there is a flaw in that. There's one really key flaw in that theory, which hasn't sort of slapped anyone in the face yet, and therefore it's sort of continuing by social contract to be the assumption, and that is that the idea that there's a limited supply of a given currency. So if I take a really simple example and I say, okay, there are 100 Bitcoin in the world, and to get a new Bitcoin, you have to mine Bitcoin, and that's costly and time consuming, and therefore it's like gold, except for there is no physical asset behind cryptocurrency, and there is no government promise, however weak we think that guarantee to be. There's essentially nothing behind crypto except for a social contract. So if supporting that social contract is the mutual agreement that its supply is limited or that its supply will be reduced in the future, my question is this: what if I invent a new coin? What if I invent something called Ethereum? What if I then invent something called Shiba Inu? What if I then invent coin X and coin Y and coin Z, right? If you will accept a Shiba Inu or multiple Shiba Inus in exchange for one Bitcoin, and you will give me 40 Ethereum for one Bitcoin, then there is an unlimited supply of Bitcoin. It's just that Bitcoin is a $100 bill, Ethereum is a $5 bill, Shiba Inu might be the $1 bill, and we have thousands of other denominations of 50 cents and 25 cents and 10 cents and so on. So as long as we have, as part of that social contract, the agreement that any one of these currencies is fungible with another, then there's actually an unlimited supply as long as people are allowed to create coins. So that, I think, is one of the fundamental things I look at, just, is a kind of an old-fashioned sort of economic mindset. I think that people probably over-rely on or sort of take the assumption that there's a limited supply as conventional wisdom, but they haven't actually tested, does that really hold true? In an infinite environment for creation of coins, no, there's not a limited supply of digital currency, and therefore it can't permanently hold value. And if people come to realize that, I think cryptocurrencies could be in a lot of trouble. There is certainly a case for a digital currency, right? A digital medium of exchange, lower, hopefully lower transaction fees, frictionless transactions. But right now that friction is very high, and the transaction costs are very high in cryptocurrencies, right? So I think the people who are really making all the money in digital currencies right now are the people who own exchanges, right? And people who are charging the exchange fees. There's definitely a role for this, and it makes a whole lot of sense to have some kind of a currency which can almost act as a basket of global value, maybe against all assets. Maybe it's maybe Bitcoin becomes the currency for Earth 2,000 years into the future, when Earth is trading with Mars and so on and so forth, right? But there are still some really significant things that haven't been worked out in terms of how this actually works from a supply side dynamic. And right now, digital currencies are massively oversupplied and people are buying into them. And again, my concern is that the people who are really chasing this now, that it's gotten very frothy, are going to be the ones who lose. It can least afford to lose. And
especially if they're doing margins and borrowing against buying more of this.
exactly.
crypto,
And then
etc.
and then we're back to 1999 and 2008, where people were, buying, just insane stuff on
No
margin
value.
accounts and get totally wiped out, right? And
Yeah.
the concerning thing, of course, around when it comes to digital currencies, is the governments around the world are very openly and very clearly signaling an attack on this, right? They also don't like the fact that this is in theory an unregulated market.
Yeah, but you could say the same thing about fiat currencies, that they're unregulated because these governments just keep printing it. That's not
Correct.
regulated anymore. Nothing's regulated except for the supply of gold, which you have to be productive in order to pull it out, refine it, create something, and go forward. Whereas right now, the cryptos and the funny money, the currencies are just get that printer out or get that little tap, tap, tap on the computer. So
and that I think is a key point, right? Is people are trying to differentiate crypto from fiat currency and saying there's a limited supply of one. In fact, there's an infinite supply, right? And I think one thing we do have to remember is when we talk about markets being unregulated, even if we assume that fiat currency is unregulated because it's just being recklessly printed, the people who are recklessly printing it are regulators. They have the ability to attack their competition.
Yeah.
And if they view digital currency as their competitor, whether in terms of the dominance of their currency or their ability to control capital flows, transaction flows, or the ability to potentially evade tax, they're going to come after that very hard, right? And
they could do the same with gold.
They could
done it in the past,
and absolutely they have done it in the past. And in the past, they've come after gold with transaction taxes, designed to essentially derive a replacement capital gains tax on not treating gold like money, but treating gold like a capital gains asset. And alternately, they've come after it to actually shore up their own reserves when they've undermined their monetary base by excessive monetary policy. So, we are in a situation that we have never been in before. And you said before, the world is different today. These are different times. They couldn't be more different than any circumstance that we've ever been in before. And essentially this idea, the gold versus crypto, we're essentially upending, or crypto is threatening to upend millennia of monetary tradition. And the idea of government monetary authority in a very short period of time. This is really a 5 or 10 year long, really 10 years into the real test of this thing. And so we can expect resistance there, and we're going to need time to settle into some kind of rationalized new normal. But as a final point on that, when you say, people aren't so interested in physical gold, or they're not anymore, part of that is this enormous disconnect that we see between older investors and younger investors, right? So there is an enormous generational gap in investment preferences.
Yeah.
And if you talk to the majority of people, 60 and over, many of them have not only not invested in cryptocurrency, they've never actually even heard of it, but they hold gold. And if you talk to probably the majority of people under the age of 30, they don't own gold because they think it's old fashioned. They're investing in cryptocurrency because it's exciting. But as the risk, well, I guess let's say as the experience of this young and new, highly empowered class of investors rises, right? The so-called Robinhood traders and the Reddit crowd, as they evolve and mature as investors, and as their natural risk preferences evolve, as they do as you get older, I think what we're actually seeing, what we're likely to see, is a larger shift toward gold than has ever been introduced in terms of demand into the gold market, actually at a younger age, because most people traditionally don't invest in gold until they're older. But now we've got people who are investing real money, who are aggressively following markets at the age of 16, 18, 20.
Yeah.
If their risk preferences shift even 5%, and they reallocate 5% to gold, you will have a multiplier effect in how many people are trying to buy how much gold at a point which is possibly 10 or 20 years younger in their investment life cycle than we've seen historically. So
Alex, we're running out of time.
Yeah, no worries.
Just do this for me. I'm sorry about this, but we are running out of time. Two things I want to know from you. What would you say to people right now? What do you think might be the tipping point? Should they be getting in now? And then I just want to talk very briefly about Barton. 2 minutes.
Yeah, look, I think, looking across the markets, we're starting to see a lot of instability in equity markets, right? And we've seen periods of volatility for the past few years, and we know that we have more debt in the system than we've ever had before.
Yep.
We know that we're starting to see really irrational behavior on asset pricing. So whether or not somebody wants to go into a hedge in the form of gold, it might be wise to, for example, speak to your broker about, hey, what are my opportunities to hedge the downside? Even if you're just looking at, index puts, right? Something to mitigate that risk exposure, right? Long-term returns optimization does not mean turn up the volume. It means be selective and mitigate your downside risk. Now, if you are interested in going into gold, there are paper options. There are paper options. There's physical gold options. You can acquire physical gold without having to go and buy a bar of gold and put it in your drawer. If you look at ABC Bullion or the Perth Mint in Australia, both of them operate deposit accounts that are for physical gold deposit accounts that retail consumers can open an account with them, buy gold in their account, and that is a physical ounce that sits in a vault at ABC Bullion or the Perth Mint. The other obvious and significant investment exposure right now is buying resources in the ground, right? So you buy shares of a gold producer, a gold developer, a gold explorer. For our part, I represented a group of investors that decided to invest in gold in the ground because we have a medium to long-term strong view on the what we think is the path for gold. That's proven to be quite accurate for the past 5 years, and I think again from the beginning of 2020 that's only been reinforced. So we invested significantly in, and I have now become the managing director of Barton Gold. And in this case, we're talking about 1.1 million ounces in the ground, growing that resource, hopefully, which we're doing, and then converting that from gold in the ground into gold in a bullion account, and hopefully at a price that is far cheaper than the nominal cost of gold at that time. So it's gold in the ground is a little bit of additional leverage to future gold upside.
Yep.
Obviously, it's a little bit more difficult when you're thinking about buying gold in the ground because you have to be very selective and you have to kind of know what you're going after. But if you can find, you can start at the top. You can start with high quality producers. Evolution Mining is a really good example for Australian investors. Excellent leadership team, excellent corporate culture. They own somewhere between 4 and 6, tier 1 or tier 2 assets at all times in
30 seconds, Alex.
World-class jurisdictions, and they produce gold, right? And right now they're producing a dividend which is greater than any savings rate you're going to get in a bank account where your money is being dissolved. So look, we favor gold in the ground. That's why we decided to go ahead with Barton Gold, and we're aggressively building that resource base there for a reason, and we intend to bring that into production in the next few years.
Thank you, Alex. And you can see Alex's presentation at the Virtual Gold Conference. It's on the website just before here. I'll put a link below. And you'll also see Alex presenting at the February Gold Conference in Sydney at Crown Barangaroo. For now, Alex, what a great overview of what's going on in the markets. Really appreciate your time. Thanks for joining me on the Gold News Channel.
Yeah, thanks for having me.